Meet Alex and David, both 25 years old, both starting with $10,000 and a shared dream of financial freedom. Their journeys began at the same point, but their approaches to investing couldn't have been more different. Alex dove headfirst into the world of stocks, reading every article and tracking every market move. David, on the other hand, took a more relaxed approach, preferring to keep things simple and steady. Little did they know, their choices would lead to dramatically different outcomes over the next 6 years. Alex was obsessed with the stock market. Every morning he scoured financial news, watched market trends, and tried to outsmart the system. He believed that knowledge and constant vigilance would give him the edge he needed to grow his wealth quickly. His days were filled with charts, predictions, and endless research. But as the years went by, Alex found himself stressed and constantly second-guessing his decisions, never quite satisfied with his progress. David, in contrast, was just an ordinary guy. He didn't spend hours analyzing stocks or chasing the latest trends. Instead, he set up a simple investment plan and stuck to it, rarely checking his portfolio. David believed in the power of consistency and patience, trusting that the market would reward him over time. While Alex stressed over every market dip, David kept his cool and focused on his long-term goals. Fast forward 6 years. The results were shocking. David was well on his way to becoming a millionaire, his wealth compounding steadily year after year. Alex, despite all his effort and knowledge, had barely grown his money. The difference wasn't luck or intelligence, it was their approach to investing. Let's break down exactly how Alex, the smarter investor, ended up losing out. In 2020, the world was shaken by the COVID-19 pandemic. The S&P 500 plummeted and fear gripped investors everywhere. Alex, terrified by the headlines and market chaos, sold all his investments and moved to cash, hoping to protect himself from further losses. David, however, remembered that markets historically recover from downturns. He stuck to his plan and continued investing, even as others panicked. While Alex was scrambling to avoid losses, David's calm and steady approach paid off. He understood that market crashes are temporary and that staying invested often leads to recovery and growth. By ignoring the noise and sticking to his plan, David positioned himself for the rebound that would follow. This moment marked the first major difference in their investing journeys. As the market began to recover, stories of overnight millionaires flooded the internet. Stocks like Tesla and GameStop soared to new heights, and social media was filled with tales of quick riches. Alex, watching from the sidelines, felt the pressure mounting. The fear of missing out, FOMO, took hold, and he couldn't resist jumping back in. Driven by FOMO, Alex bought into Tesla and GameStop at their peaks, hoping to ride the wave of excitement. Unfortunately, he entered the market just as the hype was fading. When prices dropped, Alex suffered heavy losses. David, meanwhile, ignored the noise and continued his boring but effective strategy, regularly investing in a broad S&P 500 index fund. David's refusal to chase trends or react emotionally set him apart. By consistently investing in a diversified index fund, he avoided the pitfalls of market timing and speculation. His steady approach allowed his investments to grow, even as others around him experienced wild swings in fortune. Consistency, not excitement, was his secret weapon. Then came 2022. Inflation surged, interest rates climbed, and tech stocks took a beating. Alex watched his portfolio bleed red and, overwhelmed by panic, sold his investments at a massive loss. Once again, he bought high and sold low, repeating the classic mistake that traps so many investors. David, unfazed, kept his strategy exactly the same. Same amount, same schedule, no emotional decision. Alex's emotional reactions cost him dearly. Each time the market dipped, he let fear dictate his actions, locking in losses instead of waiting for recovery. David's discipline, on the other hand, shielded him from these costly mistakes. By refusing to let emotions control his decisions, David's investments continued to grow, even through tough times. Soon after, the market surged again, this time led by AI giants like NVIDIA. The headlines were filled with stories of massive gains, and excitement swept through the investing world. Alex, still haunted by his previous losses, hesitated. Paralyzed by the fear of buying in too late, he watched from the sidelines and missed out on the recovery. Alex's deep knowledge of the market became a double-edged sword. Instead of giving him confidence, it led to overthinking and hesitation. He was so afraid of making another mistake that he missed the opportunity to benefit from the AI boom. David, meanwhile, simply kept investing as usual, letting the market work for him. Despite knowing more about the stock market than David, Alex's downfall wasn't a lack of information. It was a lack of discipline. His emotions, fear, greed, FOMO, and impatience, kept sabotaging his progress. David's simple, disciplined approach proved far more effective than Alex's constant analysis and reaction to market noise. Successful investors don't rely on predicting the future or uncovering secret information. Instead, they build systems, consistent strategies that remove emotion from the equation. David's system was simple: invest regularly, ignore the noise, and trust the process. This approach allowed him to steadily build wealth, regardless of market ups and downs. The market doesn't reward excitement or constant action. It rewards patience and consistency. David's journey shows that sticking to a plan, even when it feels boring or slow, can lead to incredible results over time. Alex's story is a reminder that chasing quick wins often leads to disappointment and loss. Most investors don't fail because the market is unbeatable. They fail because they beat themselves. Emotional decisions, impatience, and the urge to chase trends are the real enemies of wealth building. Alex's journey highlights the traps that catch so many: fear during crashes, FOMO during booms, and panic during downturns. Fear is a powerful force in investing. When markets crash, it's easy to panic and sell everything, just like Alex did during the COVID crash. But history shows that markets recover, and those who stay invested often come out ahead. David's calm approach helped him avoid this common pitfall. The fear of missing out can drive investors to make risky decisions. Alex's rush to buy Tesla and GameStop at their peaks was fueled by FOMO. Instead of sticking to a plan, he chased the latest trends and paid the price. David's discipline kept him focused on long-term growth, not short-term excitement. Panic is another common trap. When the 2022 bear market hit, Alex sold his investments at a loss, hoping to stop the bleeding. But selling low only locked in his losses. David's steady hand allowed him to weather the storm and benefit from the eventual recovery. Sometimes fear of making a mistake leads to inaction. After missing out on previous gains, Alex was too afraid to invest during the AI boom, missing another opportunity for growth. David's consistent investing meant he never had to time the market. He was always participating in the upside. Investing is as much about managing emotions as it is about picking stocks. The cycle of fear, greed, FOMO, and regret can lead to poor decisions and missed opportunities. David's story shows that emotional discipline is just as important as financial knowledge. It's tempting to believe that complex strategies and constant market analysis are the keys to success. But as Alex learned, complexity often leads to stress and mistakes. David's simple, consistent approach outperformed Alex's complicated tactics, proving that sometimes less is more. Patience is a superpower in investing. David's willingness to wait and let his investments grow over time made all the difference. Alex's impatience led him to jump in and out of the market, missing out on the benefits of compounding returns. True wealth is built slowly, not through quick wins or lucky bets. David's journey is a testament to the power of steady, long-term investing. By focusing on the process rather than the outcome, he set himself up for lasting success. Alex's story highlights the traps that catch so many investors: reacting emotionally to market swings, chasing trends, and trying to time the market. By recognizing these pitfalls, you can avoid making the same mistakes and set yourself up for success. Having a clear investment plan is crucial. David's success wasn't based on luck or special knowledge. It was the result of a simple, repeatable strategy. By creating a plan and sticking to it, you can navigate market ups and downs with confidence. Every investor makes mistakes, but the key is to learn from them. Alex's journey is filled with valuable lessons about the dangers of emotional investing and the importance of discipline. By reflecting on these experiences, you can become a better, more resilient investor. Every investor's journey is unique, but the principles remain the same. Consistency, patience, and emotional discipline are the keys to long-term success. Whether you're just starting out or have years of experience, these lessons can help you avoid common pitfalls and achieve your financial goals. In the end, Alex's story isn't just about investing, it's about human nature. The market doesn't beat most investors. They beat themselves through fear, greed, and impatience. By building a system, sticking to a plan, and keeping emotions in check, you can set yourself up for lasting financial success. Remember, the market rewards those who are patient, disciplined, and consistent.